No, when it comes to, I guess the first 6 months is, you're saying it might be a bit frustrating for the metals market, but then the next 6 months, the last 6 months of the year is going to be quite good here. So it sounds like kind of an accumulation period maybe for people the first 6 months of the year.
Yeah, that's what the pattern has been. And if you look at the current pattern on the chart, we have been, I guess the technical term is consolidating. Flagging is what technical analysts like to call it, on both gold and silver. Ever since that big rally in 2020, gold has essentially been between 1,700 and 2,000. Broke out falsely to the upside a couple times, broke down this fall falsely, and now it's, square in the middle. It's like 1850, right? It was right in the middle. And silver's the same thing. Silver been bounded by 22 and 28. It banged out a couple of times above 28, fell below 22. And now it's right back in the middle at 24. It'll probably continue to chop sideways, because the Fed, even this morning, these goons are out there saying, oh yeah, we're definitely going to keep hiking, well above 5%. And the economy is in the ditch. And so here's the thing, Elijah. They waited. You look at these goons now, they're sitting there saying, oh, there's no way we're going to cut rates in 2023. Cash Carey just said that yesterday, Thursday the 5th. Well, if you just rewind 18 months, that same guy was saying there's no way we're hiking rates until 2023. So why did anybody takes these people seriously? They're always reacting. They're never being proactive. And so they waited to hike. Inflation got to 10%. Then they went crazy. They waited, through the war. That kind of threw them a screwball. They didn't know what to do when the war started back in February. Then they went crazy with all these 75 basis point rate hikes. They can no way measure the damage they've done economically. And as we record this, the metals are soaring today and the dollar's down, not because of the jobs report, but because of these purchasing manager indices, whether they're measured by S&P Global or by ISM, are now all four. The two manufacturing PMIs and the two service sector PMIs, all four are sharply down and negative and below 50. Anything below 50 is contraction territory. The official PMIs put out by regional Fed branches like Chicago, Philadelphia, New York, they're all negative as well. Those Fed PMIs, when they've gone negative before, that has preceded 8 of the last 8 recessions. Okay, so they're batting 1,000. But the Fed, we're just going to keep hiking. They have no idea. Inflation's obviously coming down. So anyway, the key to all this, the economy goes in the ditch. The data is just going to get worse and worse through the first and second quarter. And by June, they'll either be cutting rates, which again, nobody expects, or at least be talking about it. And that's when we break out to the upside of those ranges. The spec money comes rushing in, and it gets pretty exciting again for the metals.
And you've mentioned how the Fed really has to become the buyer of last resort, because more countries are going to be moving away from the dollar and not purchasing U.S. bonds. Can you expand on that?
Well, yeah. There in the past, right, all these central banks were buying bonds, trying to keep rates down. That has led them all off of a cliff. And so now the Bank of Japan totally focused on supporting their own bond market, $180 billion a month. In December, the biggest month they've ever had. So it's not like they're supporting the U.S. bond market. The Bank of England, same thing. The Russians and the Chinese aren't buying treasuries anymore. So the Fed is, for now, longer rates are coming down. 10-year notes already down 30 basis points in the first 4 trading days here of 2023, because the Fed's getting some help by regular investors and hedge funds and cash on the sidelines going, we're going into recession and the Fed's going to be cutting again later this year. 3.5 on a 10-year note's a pretty good deal. But at the end of the day, the Fed has to be the buyer of last resort, just like the Bank of Japan's the buyer of last resort for their bond market, and around the world. We're already running, again, a more than $1 trillion deficit here in the U.S. With interest rates spiking the way they did in 2022. The interest on the national debt, that line item, well, if there was a budget, the line item on the U.S. budget would be almost $800 billion a year, this fiscal year, in servicing costs, interest costs on the national debt. The rates keep going higher, it's going to go to over $1 trillion. And pretty soon that'll exceed defense spending, social spending, and then the Fed just has to print even more to keep the wheels spinning. So this idea, we laughed. I laughed at this. I pick on Jan Hatzius because the guy's a partner at Goldman Sachs and he's making probably $10 million a year, if not more, and he's always wrong. And 4 years ago, he said, with the 10-year note at 2.5%, 3%, he said it was going to 4.5% because the Fed was going to keep hiking. And he's saying the same thing now. He was wrong then. He and his ilk are going to be wrong now. And it's just so important for people, investors in general, but particularly those invested and interested in the precious metal space, to think for yourself, man. Don't just swallow what the mouthpieces of the mainstream media and what your stockbroker reads off of what his bank is and his investment firm is telling him to say. Think for yourself and trust yourself and prepare for, again,